Good morning. This is the Subcommittee on TARP Financial Services and Bailouts of Public and Private Programs. Our hearing today is what the Euro crisis means for taxpayers and the U.S. economy. This is the first of two hearings. We have an additional hearing tomorrow morning at 9:30 a.m. in this room with the New York Fed Governor, the New York Fed President, representative from our central bank right downtown, and representative from Treasury as well. It is the tradition of this subcommittee to read the mission statement of the Oversight and Government Reform Committee. We exist to secure two fundamental principles. First, Americans have a right to know that the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government accountable to taxpayers because taxpayers have a right to know what they get from their government. We will work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and bring genuine reform to the federal bureaucracy. This is the mission of the Oversight and Government Reform Committee. I recognize myself now for 5 minutes for an opening statement. Over 3 years ago, Americans witnessed domestic and global markets deteriorate, resulting in millions of job losses and unprecedented measures by governments and central banks to prop up financial institutions. As the United States economy remains vulnerable in the midst of our recovery, just across the Atlantic, the European Union, our friends, fight to fend off a second wave of economic and financial turmoil. Today's hearing examines economic unrest facing Europe, actions undertaken by central banks and international organizations in response, options that remain at our disposal, and potential consequences to the U.S. economy and taxpayers. In 2010, what first appeared as a Greek crisis spread throughout the EU and now dictates global headlines, stock markets, and the way European nations are categorized. As events worsened this summer, the crisis began to take out heads of European states and even managed to build the closest of relationships between President Sarkozy of France and Chancellor Merkel of Germany in their efforts to save the euro. Notably, the EU instituted the European Financial Stability Facility and encouraged the European Central Bank and the IMF to take extraordinary measures to address the liquidity and perhaps the solvency issue and the crisis generally facing European nations and their banks. Thus far, it seems their actions have failed to be the bazooka markets desired. Consequently, the Greek crisis transformed into a full-fledged and full-blown Eurozone crisis, intensifying the contagion to the larger economies of Italy and Spain that have a cumulative sovereign debt of roughly $4 trillion. Today, as European leaders work to strengthen the framework of the EU, financial markets have become more dependent on the continued willingness of central banks to use their balance sheets to rescue the global economy. The central banks are not shying away from this. Just last month, in an effort to aid European banks that had trouble accessing dollars due to market skepticism about their health, 6 central banks, led by the Federal Reserve, made it cheaper for banks to borrow dollars to ease Europe's sovereign debt crisis. While welcomed by the market, some financial experts have warned that the Federal Reserve is allowing the European Central Bank to create unlimited amounts of claims against the Fed. Since Fed currency swaps reached nearly $600 billion during the height of the 2008-09 crisis, it's important to recognize what the Federal Reserve determines as prudent exposure to the European Central Bank. Furthermore, it is prudent for the Fed to review whether this precedent reduced the incentives of European banks to sell underperforming assets during the intervening calm. For instance, would European banks have acted to raise capital and sell bad assets sooner if they could not rely on capital injection from the Fed? Another item worth examination is the role of the Eurozone leaders in determining the conditions of credit default swaps on Greek bonds. After leaders declared that holders of Greek bonds would take voluntary haircuts, billions of dollars of credit default swaps were unable to serve their purpose. By these actions, the sanctity of a contract is questioned. Such uncertainty may have long-term consequences as market participants must now factor in such risk to a greater degree in the agreements that they make. If we learned anything from the last crisis, it is that impromptu precedents by governments increases uncertainty and the likelihood of capital injections on behalf of the taxpayers. In addition to market uncertainty, the reality of European banks' spreadsheets and spreading their assets and reducing lending due to undercapitalization has global markets fearful of another recession. The implications of a European recession on a recovering United States economy are significant. A second recession out of Europe would reduce U.S. exports, negatively impact the health of our banks and non-bank financials, and visibly influence the value of the U.S. dollar. With that said, the severity of these effects on the U.S. economy is anyone's guess. Consequently, the only certainty is Europe's crisis is now a global crisis. As daily headlines proclaim capital injections to the tune of billions and trillions of euros and dollars, reinforcing the interconnectedness of the global economy, it is vital that the Congress conduct vigorous oversight on rescue proposals and threats to our economy, threats to American jobs, threats to American people's way of life, threats to American people's value of the currency that they hold, their savings. Simple questions still need to be answered, such as, are the actions of the Federal Reserve consistent with its mandate, and are the firms that are seeking liquidity simply illiquid or perhaps insolvent? I am interested to hear from our expert witnesses today about their views on the Eurozone, current and potential rescue efforts, and the consequences the crisis may have on the United States economy and its citizens. I appreciate your attendance on the panel, and I now recognize the ranking member, Mr. Quigley of Illinois, for 5 minutes.
Thank you, Mr. Chairman. Today's hearing will examine what the European debt crisis means for U.S. taxpayers and the U.S. economy. Trillions of euros in debt remain outstanding for Eurozone countries like Italy, Spain, Greece, Portugal, and others. Weak revenues from a weak economy have imperiled the capacity of these governments to repay their debts, thereby risking default. A default by a major European economy would have devastating consequences for the American taxpayer. As Mr. Elliott will testify, in 2010, our exports to the European Union totaled $400 billion. We have over $1 trillion of foreign direct investment in the European Union. And we are exposed to nearly $5 trillion in potential losses on loans and commitments to European governments, banks, and corporations. If economic powerhouses like Spain or Italy were to become insolvent, the ripple effect throughout the global economy would be catastrophic. If Europe sinks into prolonged recession, American small businesses that export to Europe would lose out on valuable customers. Retirees whose retirement plans are invested in European assets would be put at risk. Our economy would grow more slowly or slide into recession, and American standards of living would decline. There can be no question that a healthy European economy is vital to the national interest of the United States and the American taxpayer. But we must protect the American taxpayer if the euro crisis is not successfully resolved. I look forward to hearing testimony from our government witnesses on what they see as a proper role, if any, of the U.S. government. Either way, Europe must reform itself. Countries like Greece, Italy, and others need to address their short-term financial challenges, but they also need to develop credible, long-term debt reduction plans. Of course, if this sounds to you like the pot calling the kettle black, you'd be right. Here in the U.S., we have repeatedly failed to legislate a credible long-term debt reduction plan. Politics, not economics, nearly saw the U.S. government default on its debt in early August. Europe's challenge is also political. While Europe surely has the economic resources to resolve this crisis, it has repeatedly failed to do so. European leaders will have to surmount their political differences and agree that saving the European Union will require a shared sacrifice. It would be tragedy if the post-war European spirit of cooperation foundered on this crisis. It would be equally tragic if our own leaders were unable to come to an agreement on steps to reduce our own long-term debt. The truth is that the mission of government matters, but reckless decisions have made it harder to fulfill that mission. I join my colleague, Chairman McHenry, in urging leaders at home and abroad to take the necessary steps to resolve this crisis and help restore the global economy to sustainable growth. Thank you, and I yield back.
I thank the ranking member. And members may have 7 days to submit opening statements for the record. We'll now recognize our panel before us today. Dr. Desmond Lachman is a resident fellow of the American Enterprise Institute and holds a Ph.D. in economics from Cambridge University. Dr. Anthony Sanders is professor of finance in the School of Management at George Mason University. Mr. Douglas J. Elliott is a fellow at the Brookings Institute. Mr. Joshua Rosner is a partner at Graham Fisher & Company. Mr. Bert Ely is a principal of Ely & Company, Incorporated, and an adjunct scholar at the Cato Institute. I believe, I know at least 4 of you have testified before, but it is a standard practice of the Oversight and Government Reform Committee that all witnesses be sworn. So if you'll please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? I do. All right. You may be seated. Let the record reflect that all the witnesses answered in the affirmative. Seeing as you've testified before, if you'll summarize your statement, you see the red, yellow, and green lights before you. When yellow pops up, that means, well, it means just what it means when you're at a stoplight. Hurry up. And obviously, green means go and red means stop. So with that, we'll recognize Dr. Lachman for 5 minutes.
Thank you, Chairman McHenry, Ranking Member Quigley, members of the committee, for giving me this honor to testify before you this morning. In my oral statement, what I'd like to do is 3 things. I'd like to set out the reasons that I think that there's going to be a significant intensification of the euro debt crisis in the months immediately ahead that could result in the euro's unraveling within the next 12 months. So this is a crisis that really does have a sense of urgency. I would then like to draw out the serious risks that the euro crisis poses to the U.S. economic recovery should there be an intensification of the euro crisis. And last, I want to consider the potential cost to the U.S. taxpayer of the various measures that have been undertaken by the IMF and by the Federal Reserve to diffuse the crisis. Over the past few months, there's been a marked intensification of the European debt crisis that suggests we could get an unraveling even as early as 2012. The Greek economy now appears to be in virtual freefall. Its banks are losing deposits. It's only a matter of time, a matter of months, before we're going to get a hard default of Greece. Second, there's contagion from the Greek crisis that is now affecting Italy and Spain, Europe's 3rd and 4th largest economies, which are regarded in the markets as too big to fail, but too big to bail. Should those problems intensify, the question of the euro's existence would be very much in question. The European debt crisis is also having a material impact on the European banking system, which is in the throes of a credit crunch that is likely to intensify in the months ahead. And what we're seeing is the German and French economies showing the clearest of signs of slowing, moving into recession. Now, European policymakers and the IMF are hoping that the countries in the European periphery can correct their large public finance and external imbalances by several years of the severest of fiscal austerity within the framework of a fixed exchange rate system that doesn't allow them to devalue to boost exports as an offset to the fiscal tightening. I very much doubt whether such an approach can work, because it's more than likely to throw those countries into the deepest of recessions, that is going to make the collection of taxes difficult, and it's going to have a very big political backlash. A deepening of the European crisis could very well derail the United States recovery. We've already had mentioned the idea that it could diminish U.S. export prospects. It could result in a weakening of the euro that would make it difficult for U.S. in third markets. But the most important channel through which the European crisis could affect the United States would be through the financial crisis. United States money market funds have got close to $1 trillion deposited with European banks. The United States banks are very exposed to Germany and France. Let me touch on the IMF and the Federal Reserve. The IMF lending commitments to Greece, Ireland, and Portugal already total around $100 billion. Considering that the U.S. has a 17.5% share in the IMF, this lending puts U.S. taxpayers at risk to the tune of $20 billion. In assessing how serious is the risk for U.S. taxpayers, it is of note that the IMF has never lent money on this scale to any country in relation to the size of those countries as it has to Greece, Ireland, and Portugal. The IMF's commitments to these countries are as much as 10% of their GDPs and 1/4 to a third of their tax collections. At the recent European summit, the European countries are proposing to make bilateral loans to the IMF to the tune of $260 billion or 200 billion euros that would be intended to loan to Italy and Spain. It is important to recognize that if those bilateral loans by the European countries give those countries a claim on the IMF as opposed to a claim on Italy and Spain, the U.S. taxpayer would be put at risk for those loans to Italy and Spain. If Italy and Spain do have to go to the IMF for large-scale loans, the exposure of U.S. taxpayers to those countries could be enormous. Considering that the IMF's combined lending commitment to Italy and Spain could well exceed $1 trillion, what we're talking about is U.S. taxpayers could be at risk for up to $200 billion. In assessing the potential risk to the U.S. taxpayer from IMF lending to European periphery, one has to consider that the risk of the unraveling of the euro is a distinct possibility. Were that unraveling to occur in a disorderly manner, it would have a devastating impact on the European periphery's economic outlook and its public finances. Considering that IMF loans to the periphery could reach levels that would be unprecedentedly high in relation to those countries' taxpayers, there would be a material chance that those countries would have difficulty in repaying those loans. Lastly, judging by its 2008-9 experience with currency swaps, the Federal Reserve's dollar swap lines could reach $600 billion in the event that the European crisis were to intensify. However, one must suppose that the risk to the U.S. taxpayer from the Federal Reserve swaps would be circumscribed by the fact that the main counterparty to those swaps would be the European Central Bank rather than the countries in the European periphery, and one should suppose that the European Central Bank could print the euros to buy the dollars to repay those loans. Thank you.
Thank you, Dr. Lachman. Dr. Sanders.
Chairman McHenry, Ranking Member Quigley, and members of the subcommittee, thank you for inviting me to testify today. The Eurozone is teetering on collapse, and it's been decades in the making. The cause of the problems is excessive government spending, leading to excessive government debt, coupled with slow GDP growth. The largest European countries are expected to have real GDP growth of 1.3% for 2012 and unemployment of 9.9%. The IMF has also produced a long-term real GDP forecast in which they've discovered that most of the European zone will have less than 2% GDP growth by 2016. And if we take a look at the household and financial debt in Europe, we find out that the UK's debt to GDP ratio, including households and financials, is over 900%. Japan is over 600%, and Europe is almost 500% debt to GDP. The U.S. is over 300%. In summary, the Eurozone, Japan, and the U.S. are drowning in debt. And a recent article from economists at the European Central Bank itself shows that there is a significant negative effect of the size of government on growth. The European Union will unify, break up, or downsize, but regardless of what option they choose, they are still spending too much money and have taken on too much debt and have reduced ability to pay for it, which is slow GDP growth. Additional debt is not the answer, it is the problem. The obvious solution is austerity, but making loans to the European Central Bank and individual countries does not solve the underlying structural problem. It only makes the debt to GDP problem even worse. It is simply a short-term solution, but with low GDP growth, how is this possibly going to help bail out the European situation? Now, if Germany and France are successful in creating a fiscally integrated Europe, there will be less of a rush to purchase U.S. treasuries, leading treasury rates to rise as people flee our markets. But given that the Fed is already the largest purchaser of U.S. treasuries, this could be a problem. China is flat on treasury purchases, and the U.S. and Japan, or UK and Japan, continue to increase their purchases of treasuries. But the UK and Japan are not enough to pick up the slack from China's flatline treasury purchases. Now, the Fed has been active in the European bailout starting in 2007, actually a little bit before, with its discount window operations, and it peaked in 2008. The largest European borrower from the Fed was the failed Belgian bank Dexia. While most of the discount window loans have been repaid, we are still in the dark on the guarantees. Recently, the ECB drew $552 million from the Fed's swap line last week in November. These are 7-day swaps at an interest rate of 1.08%. The central bank also borrowed the same amount in the prior week, et cetera, et cetera. It begs the question, how long will the Fed keep the swap line open? While we cannot see the swap line in real time, the evidence indicates that the basis swap has a very short half-life, meaning that it's able to drive down the euro rate just momentarily, then it immediately rises back up, showing that this is ineffective. A recent disagreement about the size of the Fed's intervention, discount window, and guarantees was in the media between the Fed and the Bloomberg Markets magazine. The Bloomberg Market said that the Fed had committed $7.7 trillion as of March 2009, almost the size of our national debt at one point recently, to rescuing the financial system, and all guarantees and lending limits were added up. The Fed disagreed and said that on any given day, the Fed emergency credit from liquidity programs was never more than $1.5 trillion. Whatever we are looking at on any given day or the cumulative impact, these are very large numbers historically indicating the Fed is in fact attempting a bailout of the Eurozone. Now, on the Fed side, it is clear that the guarantees of the Eurozone could be problematic to U.S. taxpayers if things do not improve, and I just don't see the story for improvement in the Eurozone. And the swaps with Europe could be costly as well. Since there is little transparency on the Fed's discount window and guarantees, it is difficult to measure taxpayer exposure. In addition to the Fed, the IMF, which is the U.S. is the largest stakeholder, is also active. They have a line of credit for IMF crisis fund in the amount of $100 billion. Given the structural problems facing the Eurozone, there is little likelihood that the Eurozone will continue to have problems, since there is a lack of will to cut government spending and entitlements. So I would expect that the $100 billion LOC to be used and not paid back. In summary, the Eurozone's structural problems cannot be solved by low interest rates and guarantees from the Fed or the IMF. In fact, engaging in a bailout of Europe could actually jeopardize U.S. taxpayers and is a perverse solution of the problem. The best way to protect U.S. taxpayers is to increase transparency at the Fed, take back the $100 billion line of credit at the IMF, and undertake spending cuts ourselves in order to reduce our deficit and massive debt loan exposure. Thank you.
Thank you, Dr. Saunders. Mr. Elliott.
Let me add my own thanks to you, Chairman McHenry, Ranking Member Quigley, and members of the subcommittee for inviting me here today. As has been noted, I am a fellow in economic studies at the Brookings Institution, but I am here in an individual capacity and not representing the institution, which does not take policy positions. I commend you for calling this hearing, since the euro crisis is deeply worrying. There is a significant chance that the crisis could go badly enough wrong that Europe plunges into a deep recession that puts the U.S. into at least a mild recession. Trouble in Europe will communicate itself to our shores strongly and quickly because, as the Ranking Member noted, we have $400 billion of exports, of dollars of exports to Europe annually, $1 trillion of direct investment there, and our banks have almost $5 trillion of credit exposure. Now, the good news is that the Eurozone as a whole does have the resources to avoid that kind of disaster if the 17 nations stick together effectively. Europe is one of the world's largest economies, and the Eurozone as a whole has debt ratios similar to the U.S., meaning that their fiscal problems require serious action, as ours do, but the situation can certainly be remedied. I personally believe there is a 3 in 4 chance that Europe will muddle through, but very complicated political constraints in Europe still leave us with a 1 in 4 chance of disaster, again, in my view. Even assuming a good outcome, the crisis is likely to get worse before it gets better, as it will probably take the imminent possibility of catastrophe to allow politicians over there to break through those tough political constraints. At that point of crisis, it may be necessary for European leaders to produce a comprehensive package backed by as much as 2 trillion euros of available funds. Not all of this would be used in practice, as long as a backstop this large is credibly committed. The markets need to know that there is insurance for the worst emergency, in which case they are likely to go back to supplying at least some of the necessary funds themselves. I believe the IMF could play a very useful role in any comprehensive solution. First, adding some IMF funding to the mix would help reassure financial markets that the total resources necessary would in fact be available. Second, it would be a clear sign that the rest of the world stands ready to help Europe through its troubles, which should also be viewed positively by the markets. But most importantly, the IMF is in the best position to impose conditions on lending to troubled Eurozone countries, since it is viewed as more dispassionate and less political about Europe's situation than would be true for purely European institutions. Further, it can provide a great deal of technical advice, which is more likely to be taken when the IMF is also a provider of funding. We all listen more carefully to people who are also providing money to us. If Europe produces a credible and comprehensive plan that involves the IMF appropriately, then we should support that IMF role. I do not believe that this would require additional U.S. funding of the IMF, but just the use of resources we have already provided. The IMF has almost $400 billion of uncommitted resources, and Europe is planning to commit another 200 billion euros to the IMF, with the possibility of some matching funds from certain non-European nations, not including the U.S. The risk to the U.S. taxpayer from IMF lending, I believe, would be small for a variety of reasons. A key one is that IMF lending is in a legally privileged position that makes it much safer than, for example, the TARP funds that were invested by U.S. taxpayers. IMF loans are effectively senior in their claims to all other borrowings, whereas the TARP funds were deliberately invested at the level of equity, which is much riskier. This was done in order to stabilize the financial markets by protecting other suppliers of funds to the banks. In addition, even if everything does go wrong, the U.S. bears less than 1/5 of the risk from IMF lending. I want to emphasize our taxpayers and other citizens are already at great risk from the euro crisis. If it goes badly wrong, our citizens and the businesses they own will lose large sums of money, both here and abroad. Federal government tax receipts will fall significantly, eventually requiring taxpayers to pay more than they otherwise would have done. In my view, supporting IMF intervention would reduce the total risk to America by much more than the quite modest financial risk that our share of the IMF funding would represent. Sometimes the riskiest choice is to take no chances at all. There are a few other things that America can do, principally along the lines of the Fed swap facilities with the European Central Bank that have been described and the provision of technical advice. However, this is a European problem, and they will need to provide the backbone of any solution. Thank you for the opportunity to testify, and I welcome any questions when we get to that point.
Thank you, Mr. Elliott. Mr. Rosner.
Thank you, Chairman McHenry, Ranking Member Quigley, and members of the subcommittee for inviting me to testify on this important subject. To fully assess the risks to the United States and our proper role in the Eurozone crisis, it must first be clear what the crisis is and is not. It is not a bailout of populations of the weaker European economies such as Greece, Ireland, Portugal, Italy, Spain, Hungary, or Belgium. After all, the populations of those countries are being forced to give up portions of their sovereignty in the name of austerity towards a fiscal union. Rather, it is partially a bailout of banks, in the core countries of Europe of their stockholders and creditors who, failing to gain sufficient access to capital markets, would need to be recapitalized by their host country governments. It is a transfer of losses from bank creditors onto the backs of ordinary people without requiring any cost to those banks whose practices helped lead us to the problem. It is much a tale of overlending as it is of overborrowing. And just as nobody should feel undue sympathy for those who miscalculated the amount of debt they could service, nobody should feel for those who miscalculated their lending risks. The fundamental construct of the euro is flawed, and its basis depends on substantially different economies and different levels of competitiveness among those economies sharing the same currency. Those economies have proven unable to rationalize their differences in a monetary union. In the United States, we have a transfer mechanism allowing tax dollars to be reallocated from the wealthiest states toward those less fortunate. The core European countries have demonstrated an unwillingness to accept such as necessity. The solution is either to move forward with a fiscal union complete with transfer of payments or break up. Ultimately, these are political decisions, and currently there appears to be little popular support in Germany, Finland, and the Netherlands for such a real fiscal union. Unless that changes, the Eurozone will have to shrink its membership or dissolve. Either result will inevitably lead to significant stakeholder losses, which importantly may now include the Fed. Proper U.S. policy should support our values around the world, not undermine them. We should support the apportioning of losses first to equity investors and then to unsecured lenders according to long-established and well-understood rules of priority. We should no longer support privatization of gain and socialization of loss. Doing so leads to distortion of market incentives and further risk-taking by those who have demonstrated an inability to properly manage risk. The European crisis demonstrates all too clearly that the problem is now well beyond moral hazard. A great many of the decisions being made in the name of crisis management are not being made by the elected representatives of the people of the countries of Europe. Rather, they are being made by technocrats. Accordingly, the crisis is moving into a stage where it may represent the death of representative democracy, but also the destruction of global markets. I urge you to consider whether this is truly the approach to crisis management that our country should be supporting and endorsing. In May 2010, the Fed reopened swap lines to the European Central Bank in an effort to bolster liquidity for institutions in these markets, but at what cost? On November 30th of 2011, to increase the attractiveness of these lines, the Fed lowered the interest rate by a half percentage point. Since then, 3-month lending through the lines increased from $400 million to over $50 billion. While the actions of the Fed may well be justified and consistent with U.S. policy goal, they are nonetheless being made in near darkness and without substantial involvement by our own elected officials. As a result of this commitment of financial support, we are now supporting undemocratic approaches implemented largely by authorities who have demonstrated an ongoing inability to either recognize the scope and scale of the problems or come to a consensus on how to address the rolling crisis and prevent it from spreading. They have instead sought to deny the problems and downplay the impacts. When they don't like the market's assessment of the problems, they have chosen to shoot the messenger and imperil market function through limitations of trading of sovereign bonds and credit default swaps. Are these proper policies for the United States to endorse? By providing unlimited swap lines to be used by institutions in the Eurozone, institutions which may in fact be insolvent, not just illiquid, we have effectively allowed the Fed to direct U.S. foreign policy in support of a single currency for the Eurozone. As the risk of the losses of the Fed rise in the event of a breakup of the Eurozone, they seem likely to commit us further to support of that union in its current form. While the Fed has technical expertise in these matters, such policy decisions should not be made without informing Congress. I suggest that you consider whether the Fed's efforts should be directed more towards quantification of the problem and providing technical advice to Congress. Dodd-Frank sought to reduce the opacity and required the Fed to disclose which firms received loans from the discount window. In the spirit of that legislative intent, why hasn't the Fed required the ECB to inform them of recipients of funds from swap lines as condition of the arrangement? While there are many more questions to be asked and answered, these questions suggest there are real reasons for the Fed to have concern about ongoing instability in highly interrelated markets of Europe. there also appears to be a real and rational basis for the actions they have taken toward short-term stability goals during the crisis. Furthermore, we can believe the Fed is acting appropriately, but without more information and a broad discussion, we don't know whether the Fed's focus on short-term stabilization properly aligns with longer-term U.S. policy goals. Perhaps we should support a European Union, but have our elected representatives affirmatively decided in favor of continued support for a single currency? It seems fair to consider that such foreign policy decisions should rightly be made not by an independent central bank, but instead by the Secretary of State, U.S. Trade Representative, and the Secretary of Treasury with informed consent of the President and Congress. Thank you, and I'll be pleased to address your questions.
Thank you so much, Mr. Rosner. Mr. Ely.
Mr. Chairman McHenry, Ranking Member Quigley, and members of the subcommittee, I appreciate the opportunity to testify to you today about the Euro crisis and what it could mean for U.S. taxpayers and our economy. I wish I could speak more positively about the Euro situation than my fellow panelists, but I fear that I cannot. Europe would not be experiencing its economic crisis if the Euro had never been created, or if at least the Eurozone had not been expanded to 17 countries. The fundamental problem with the Eurozone is that it ties 17 quite dissimilar economies to a common currency. While the total population of the Eurozone approaches that of the U.S., the Eurozone lacks the economic, cultural, and language integration that has long benefited the U.S. The Eurozone's insufficient integration greatly impairs the sustainability of the Eurozone as it is now constituted. A key characteristic of a sustainable currency area such as the U.S. is that there are minimal barriers to the movement of goods, services, and labor within the currency area. Unfortunately, these keys to sustainability are not present in the Eurozone as it is now constituted, as there still are many practical barriers to the movement of goods, services, and labor within the EU. Arguably, the Euro subsidizes the retention of national laws which impair the efficiency of industry in the Eurozone countries, and especially export-oriented industries. Consequently, export goods produced in these countries have steadily lost international competitiveness. This is especially true across the southern tier of the Eurozone, Greece, Italy, Portugal, and Spain. In many regards, the Euro suffers the same weaknesses as the classic gold standard, which the U.S. abandoned in 1933, or any commodity standard which ties several or many countries to a fixed relationship between the currency units of account of those countries. Because national economies evolve at different rates of economic growth and public policy innovation, economic tensions develop among countries tied to each other by a common currency. The fixed relationships between units of account become increasingly difficult to maintain until a breaking point is reached and the fixed relationships are irretrievably broken. The same phenomena is occurring within the Eurozone. Abandoning a common currency represents a country's shift from a fixed to a floating exchange rate. Abandoning the Euro, though, would be quite painful for a country. First, debts such as mortgages and bonds denominated in euros would have to be abrogated and rewritten in the new local currency to spare debtors from being crushed by repayment obligations in a now suddenly more expensive euro. Second, owners of euros in the weak euro nations, fearful of being forced to convert their euros into their country's new, less valuable currency, appear to be shifting their euros to banks in stronger eurozone countries. The recent last-ditch attempt to fix the euro by amending the EU treaty to impose greater fiscal discipline in the EU will not work in the short term because the fiscal problems in many eurozone countries are so deeply embedded that they cannot be fixed within a few years. It will be a decades-long process that will not move at a uniform pace throughout the eurozone. My written testimony discusses these problems. Bottom line, the weaker eurozone countries have much to do to enhance their ability to stay in the eurozone. How many will succeed in doing so is a huge question with global implications. Turning to how a euro crisis could impact the U.S. economy and U.S. taxpayers, a euro crisis could throw the EU into a recession. However, if enough dominoes topple within the eurozone, Europe could experience a long, deep recession or worse. Given the highly interconnected nature of the global economy, U.S. exports to Europe would decline, which would harm the U.S. economy. A European recession could trigger a global economic slowdown, with the U.S. possibly falling into a recession as the European economy sorted itself out. A slowing U.S. economy would increase the already enormous U.S. budget deficit as tax receipts declined and federal spending rose. Consequently, the U.S. economy would increasingly look like the most troubled European countries. Huge budget deficits and a rapidly rising debt-to-GDP ratio. It would not be a pretty picture. Unfortunately, the U.S. has few options for dealing with the euro crisis. The best it can do is urge the EU to aggressively address its problems in order to hold the eurozone together as best it can. I am skeptical as to how much help the IMF can be. In particular, the U.S. should encourage the weaker eurozone countries to address structural problems impairing their competitiveness, thereby improving the likelihood that they can stay in the eurozone. Given its financial weaknesses, the Federal Government should not supply any direct assistance to help the euro, such as buying the debt of any eurozone country. However, I do support the U.S. dollar swap arrangements the Fed recently entered into with 5 other central banks. These arrangements provide liquidity to help the European financial system function while the EU works through its problems. I foresee no taxpayer risk from these swaps. The U.S. should take the euro crisis as yet another wake-up call that it must put its economic house in order by trimming budget deficits, reducing its debt-to-GDP ratio, increasing domestic savings, reducing the U.S.'s net debtor position with the rest of the world, addressing entitlement challenges, removing taxes and disincentives for savings and investing, and increasing the economy's international competitiveness. This is an enormous, politically challenging task, but as a country we must undertake it, for we are not immune to being laid low by excessive debt and deficit spending, as has Greece and possibly other eurozone countries. Thank you for this opportunity to testify. I welcome your questions.
I think the panel's testimony will now go to questions. I recognize myself for 5 minutes. Dr. Sanders, let's begin at the beginning. The Federal Reserve has foreign currency swaps. It's a normal function of the Federal Reserve for quite a number of years. Explain what that means.
Well, in a nutshell, what it means is that the eurozone can actually swap currencies with us. In other words, we send cheap dollars over to Europe, and they ship expensive euros over to the United States.
Okay. So why is this an issue that the Federal Reserve in this current environment? Why is this foreign currency swap agreement an issue right now?
Well, again, it's not being done at parity, which means we're just not providing them, swapping the currencies at a market rate. It's a subsidized rate. We cut the rate on it.
Okay.
And so in other words, we're again, subsidizing Europe through the swap. Okay,
so really the issue here is that we've reduced the cost of this exchange and made it below what is the current market rate, therefore incentivizing the European Central Bank to transact this type of swap agreement with the U.S. Federal Reserve. So what is so in light of that, Dr. Lachman, I've asked you this question before. What are your chances, what do you see in your view, the likelihood that the euro makes it out of this, that the euro actually exists as a currency in the medium term?
I think you need to distinguish between losing a number of countries and the whole euro disappearing. I think that it's very likely that within the next year, 18 months, we're going to see several countries exit the euro. We're going to see countries like Greece, Portugal, Ireland, probably Spain, be forced to leave the euro. But the euro itself as a currency between Germany and like countries, the northern European countries, probably including France, that is very likely to continue to exist.
Let's go across the panel. Dr. Sanders, do you agree?
Again, as I said in my reply, I don't think the euro can be saved. They can save the core, but the fantasy that they can bail out the pigs, whether it's the pig banks or the loans to the pigs, whatever, it's mission impossible. They can't do it. So it's got to break up.
Okay. Portugal, Italy, Ireland, Greece,
Spain.
Thank you. Just want to make sure, because Occupy Wall Streeters have a different analysis of what a pig is. Mr. Elliott.
Yes, I'm completely confident the euro will continue to exist. Certainly the core, absolutely. And I think it's highly likely that all 17 members stay.
Mr. Rosner.
I think it's likely in the medium term that the euro continues to exist. I think that it will be difficult to have members exit, but I do expect there to be an exit of some peripheral members within the medium term.
Okay. Mr. Ely.
Yes. I think I'm generally in agreement with my fellow panelists. I think the weaker countries are going to have to exit, and again, basically it's the southern tier countries, plus possibly Ireland. If they leave, relatively soon, this actually could be, despite the problems of transitioning back to their previous currencies, this may actually be positive for them and for the global economy, because they will have cheaper currencies, their exports will become more competitive, and this may be, as painful as it's going to be for them to exit, this may be better both for those countries as really, and for the global economy, if they leave sooner rather than later, so they can go through the adjustment process. For the remaining countries in the core, again, they have to address the classic problem of any kind of common currency area, and that is that within any one country, the policies are not too far out of sync from what they are in the other countries in that currency area. That's a huge long-term challenge.
Mr. Rosner.
Yeah, you have to remember, though, part of the problem that we've watched in the way they've tried to address the crisis thus far is that they've tried to avoid that default from occurring in the periphery by any means. And so we've watched attempts to come to voluntary write-downs of debts, of Greece as example, and try to do so without it becoming a default in name, triggering the CDS. That's part of the problem of the core, is they don't want to allow it to be called a default because of what that would mean for CDS. It creates a problem, though, in the timing and the delay. We've delayed this, and so at the point where Greece was recognized as a problem, the credit was probably trading or should have been valued at about 80. And today, we're trying to get 50% write-downs, and the truth is the Greek debt is not even worth that. The longer we wait, the larger the write-downs will be, but that's being stymied, the timing of that, by this intent to do everything we can to avoid calling it a default, when ultimately it will end up a disorderly default unless we recognize it as something that needs to happen sooner rather than later.
Now, my time has expired, but to the point here, why this is a discussion and why we're having this hearing today is in light of opening up a below-market rate, swap rate with the Federal Reserve, and the view that the survivability of the euro as it currently exists does expose the taxpayer to risk. That is the concern that we have today as policymakers, and that's why we're trying to have this oversight hearing today. With that, I recognize Mr. Quigley for 5 minutes.
Thank you, Mr. Chairman. Mr. Ely, you said something that made me alter what I was originally going to ask. You said it might be better for these smaller countries to be forced out and then go through this adjustment period. Are you assuming that they're going to get significant help before they're forced out, or they're just going to have to go through this painful adjustment process to get to that on their own?
Again, this is all highly speculative because we haven't had any exits from the euro before. My sense is that they would not get much help. But what the exiting would do would help in number one, it would probably lead to the kind of debt restructuring that Josh talking about, but also it would enable them to, their currency would be more competitive, their export goods would be more competitive, they'd be more attractive for tourism. That's particularly thought to be the case with Greece. And I think that this would allow them to start to turn around their economies. The alternative, by staying in the Eurozone, is just an increasingly draconian austerity, which potentially can create some very serious political problems. But I think it's like in any kind of bankruptcy situation. At some point in time, you have to recognize the reality of it, go through the debt adjustment process, and deal with competitiveness issues. And I think that for some of these countries, the only way they can do that is by leaving the Eurozone.
If anyone else on the panel would like to chime in, I guess I want to understand more thoroughly why standing, Mr. Elliott, why standing alone would be good for them and what impact it might have on the United States.
I'd like to say two things. First is a background point, which I'd be happy to expand on. You're hearing, in large part, political judgments here. You're hearing judgments as to whether these countries have the political will and capability to deal with their longstanding problems.
And while you answer that, sorry for interrupting, if you could add, I mean, it seems to me from your previous statements that they have the financial capability of solving this, and this is all about political will.
That's certainly my view. If you take the Eurozone as a whole, they have clearly the ability to deal with this economically. And so then the question is, will they take the political actions necessary to do so? As you can tell from my testimony, I'm significantly more positive about that than my fellow panelists. One reason for that is I think too often we look at what has been agreed to date and think that tells us what the ultimate outcome will be. This is like looking at the debt ceiling debate here a few days before the agreement and concluding there will never be an agreement because they're so far apart, or looking at the current budget negotiations and assuming that because we can't seem to agree, the government will shut down and never start up again. I think there's very strong political will within Europe to get through this together. They've made a lot of mistakes. I'm not trying to say they've been brilliant about this at all. But my view is when they get to the edge of the abyss, they really will be likely to do what they have to do.
Dr. Sanders, you seem
Agitated? No, I just want to throw my 2 cents and agree with something Josh said.
That's one of our jobs here.
I think one of the only solutions for them is to write down the debt. But again, that is politically, as Mr. Elliott said, dangerous, but it's also economically dangerous and perhaps impossible. They just came out with a report the other day saying Greece is not following austerity. They're not moving fast enough. In fact, they're kind of dragging their feet. Is that a surprise? Absolutely not. This was predicted a long time ago. So in other words, any bailout is going to have to be serious. Banks are going to have to take it on the chin. Governments are going to have to take it on the chin. And again, look at the debt loads and government spending of even Germany and France. They're massive socialist states. They can't do this either in the long run. Maybe we can do it for a year, but forget it over the long run. They're just all too debt-laden and all too big.
Dr. Latchman.
I think that the essence of the problem in countries like Greece, Portugal, and Ireland is that these countries are insolvent, and providing them with additional funding isn't a solution. It's not just a question that this is a political problem. It's a problem that they can't reduce those imbalances within a fixed exchange rate system. If they try to do massive amount of fiscal austerity within a fixed exchange rate system, you get the result that we're seeing in Greece with the country collapsing. When the country's economy collapses, they don't collect the taxes, the debt ratios rise. Greece's debt ratio at the start of the IMF program was supposed to peak at 130%. The latest IMF estimates are that it's going to peak at 190% of GDP. This country is clearly insolvent. One has to write down the debt, and then one has to deal with the problems that that causes for the banking system. If I might just add one point, just in connection with the swaps that the Fed is making, to be sure they're providing cheaper credit, but part of the reason for that is the United States money market funds have huge amounts of deposits on the banks of the European banks that they're trying to repatriate back home. So by providing those kind of lines of credit, we're not simply helping the Europeans, we're helping ourselves by avoiding any of these money market funds eventually having to break the buck as they did in 2008.
Thank you. My time's expired.
Mr. Cooper for 5 minutes.
Thank you, Mr. Chairman, and thank the distinguished panelists. I think perhaps the most important question is the simplest. Is this a crisis of the Eurozone or really more of a crisis of the West? Because most of you have pointed out that just the trade implications alone mean that we have a stake in this crisis, whether we want one or not. So when you glibly talk about taxpayer exposure, we have to remember that countless Americans are shareholders, and they're shareholders in institutions that perhaps have lent tens, hundreds of billions, maybe even trillions of dollars to countries or entities in the Eurozone. It goes without saying that we share many cultural and other ties with this troubled area. And sometimes unspoken is the idea that the entire capitalist system is built to some degree on confidence and leverage and trust. Just a few years ago, there was a prominent banker at Citicorp, Walter Wriston, who had the famous doctrine that no sovereign country could ever default. And he was not a creature of government. He was one of the preeminent spokesmen of the U.S. private sector. So things have a way of changing. Here.
If I could address that, Mr. Wriston obviously didn't know his history, because there's certainly been plenty of sovereign defaults before he made that statement, and we have seen them since, and unfortunately they'll probably continue. With regard to the question whether this is a crisis of the West or of capitalism, I think things have become so intertwined globally that it's really a global, potentially a global crisis. And when we look beyond the West, let's say to Japan or to China, to pick two countries in Asia, each of them have some very serious problems. Different in some regards, but in Japan, for instance, we have debt to GDP ratios that or debt to GDP ratio that exceeds, I believe, any country in Europe, and in China, I think a lot of people are just waiting for that bubble to blow up. So I think that it's more than just a crisis of the West or of capitalism. I think it comes back to the issue of just too much debt. I believe Josh made that point that there's just too much spending on the global credit card, so to speak, and that's what has to be reined in, including in the United States.
These are all valid points. It's a complex issue. Too much debt generally depends on the ability to repay, and that is itself subject to many different factors. David Walker, the former Comptroller General of the United States, pointed out that at least according to his measure of fiscal responsibility of the top 34 nations, that the U.S. ranks 28th behind some of the countries in Europe in terms of our fiscal responsibility. Now, there are different ways to measure this, and none of us wants to be unduly alarmist. But we clearly have a lot of work to do in our own country, since our own credit rating was threatened this summer for the first time in modern history. So as we approach these issues, another dimension seems to be almost the longer you wait to deal with it, the more the contagion spreads and the greater the risk to confidence. I wonder almost if we'd intervened early with Ireland or Greece or one of these most troubled nations, if the contagion could have been limited. Of course, the origin of all this seems to be excessive debt, inability to repay, promises that can't be kept. And we're certainly subject to that in this country, when so often we even refuse to acknowledge the real debts of our own country, the real obligations. So I see that my time is expiring. I recall that one person has called for a competition to have the best idea to calmly allow a sovereign nation to default or a sovereign nation to leave the Eurozone. Are you aware of any good ideas in that area so that the dismemberment can be managed in a sensible way, if indeed that's what it comes to?
I believe I'm the one who made that comment. There actually is a little bit of historical experience with currency arrangements, currency common areas, and the like coming unglued. But not quite of the certainly nothing of the magnitude that we have today. It's not going to be an easy process, but I think it comes down to a question of what are the alternatives? As bad as it may be for someone to exit, is it potentially worse, not only for the particular country, but for the broader economy, to delay the inevitable? And I frankly think, the more I look at this, the more I think the sooner the problems are addressed, the better.
Thank you, Mr. Chairman. I see that my time has expired.
Mr. Meehan of Pennsylvania for 5 minutes.
Thank you, Mr. Chairman. I want to thank each of the panelists for your preparation for this and the remarkable capacity you had to take these complex issues and try to put them down into 5 minutes. That in and of itself is a challenge. But this is a sobering issue, and I thank you for the work you're putting into it. Dr. Sanders, you mentioned something that I wasn't quite sure I understood, that there was a discrepancy in the identification of whether some of these commitments were $7 trillion or $1.5 trillion. The Fed disagreed. What is that about, and why aren't we getting unanimity about something that fundamental?
What that's about was the Fed did not disclose their discount window operations, and they still haven't disclosed exactly fine details on it, and they have not disclosed their guarantee programs yet. But what happened was, with the Freedom of Information Act, Fox News and Bloomberg asked for the discount window information. It was produced, but the Fed and Bloomberg counted it differently.
I think it was Mr. Rosner that used the word opacity. But isn't this the essence of why are they entitled to be able to keep that kind of fundamental information if it's tying back to guarantees from United States taxpayers private?
Well, I think the way I would answer that is I think they're worried about bank runs. And so if they don't disclose the discount window, then there's not information out there. Although, again, I would argue the exact opposite. I would say if there's a threat of a bank run, I want to know that information in advance. I don't think the Fed should be putting American taxpayers at risk, although they've lowered interest rates so low that retirees and fixed-income households are already getting pummeled, but that's a different issue. No, so they're getting harmed by the euro crisis that way. But, again, I think Chairman Bernanke will defend the Fed being secret. I think, a lot of these problems would be settled down a little bit if we had made them transparent. They really should be.
Mr. Rosner, you used the word opacity. I was struck by that. I made a note on it, and I think that, why isn't the European Central Bank being asked to tell who's getting the loans or respond to my first question? I'm interested in your insights.
I think it's a great question, and I think that part of the problem here is that there's a huge difference between illiquidity and insolvency. And one has to wonder whether part of the reason of the opacity is to protect those who are seen as illiquid from being shown to be insolvent. Okay? And I think that's something that—
What do you see as the difference? What is the difference between illiquidity and
insolvency? If you have short-term funding issues, but the assets on your balance sheet actually allow you to be well capitalized over the longer term, you're solvent. If you're fundamentally insolvent, you're insolvent, and no amount of liquidity will repair that. It will just smooth over the market impact of that for the short term. But this is part of the problem that's going on, is the Europeans have taken step after step to make claims of solvency over institutions that are fundamentally insolvent and mask it in illiquidity or liquidity problems.
And would they be principally these, the countries that—
Well, I think it's—
Italy—
No, I think it's also the core. I think, as we've seen, you've had problems at Dexia, you've had problems at Commerzbank, you've had problems, at several of the German and French banks. And it's not clear to me that they're just liquidity problems. It seems to me that in some cases they're insolvency problems. In fact, I think we also have to recognize that part of the fiscal disciplines that everyone is talking about, everyone is calling for, includes getting governments out of the business of providing funding for creditors' benefit on institutions that are fundamentally insolvent. That is a commitment of fiscal resources towards private creditors as opposed to allowing market discipline to force losses to be recognized by those creditors.
And what do we do then to make those creditors who, I guess, are passing on that risk, so to speak? How do we put them back into their appropriate place in the line so that they are the ones who accept both the benefit of the risk but the impact of the downturn?
I think to some degree it's by stepping away. It's certainly not by doing what the Troika in Europe did to Ireland, which is force the Irish government to recognize the debts of its banks as sovereign obligations as a way of preventing core banks from having to take losses on those obligations.
Well, would the run on the banks then cause there to be an overall run on the
I
whole
think there would
European
be
system?
runs on insolvent institutions if we had enough information. I don't think that there's a problem if regulators stepped in ahead of that run and shut down or forced good bank, bad bank resolutions of those institutions that were fundamentally insolvent. We would head off the bank runs as opposed to what we're doing, which is the capital markets keep trying to give information to the European leadership, telling them where the problems are, and the leadership does everything they can to avoid that coming out. We saw a bank stress test in Europe in the spring of 2010 saying that only 7 of 91 institutions had real problems. Now, we've seen since then that that stress test was deeply flawed and inaccurate. We have done quite a bit to cover up insolvency issues in the name of illiquidity or liquidity issues.
Thank you, Mr. Chairman. I yield back.
Thank you. And Mr. Rosner, I know you detailed that in the American financial system in your book, Reckless Endangerment, which is quite a read. So, but Mr. Welch, for 5 minutes.
Thank you, Mr. Chairman, for calling the hearing. Thank the panel. Is it basically the consensus that Congressman Meehan's question that implied more information is better is a point that all of you agree with?
No.
And do the others agree with it?
Yes.
Yes.
I agree that better information that more information is better, but the key question is how do people and how do policymakers specifically react on it? What counts is not what's spoken, but what actions are taken.
So is that a you can't handle the truth?
That's actually that is to a great extent.
Well, let's go to Mr. Elliott. You say no. I mean, it's hard to understand. That sounds like what we like. Is as long as we can confuse voters, then we may be all right.
Well,
But voters don't like that, and rightly so. So why do we have that standard that appears to apply to bankers? Mr. Elliott, you seem to be saying there's some upside to keeping things obscure.
It's a question of balance. That is, I agree in many ways with what Josh was saying, but the problem is in practice, particularly in the middle of a crisis, it's often very hard to tell the difference between illiquidity and insolvency. And so there's a fear that, for example, if you publish the discount rate, the discount window borrowings in the short term, so people know very quickly, that if a bank does borrow a lot of the discount window, which is secured borrowing, they actually bring good assets generally to get that money, that if they do that, which is important for liquidity, they'll be seen as potentially insolvent.
So let me ask.
And so I think most people agree that the discount window, if you do publish it, that you do at least want a delay of time.
Right. So then there'd be a difference in your view, if I understand what you're saying, about managing information in the midst of a crisis where the market may react emotionally and hair trigger. But what about having systems that allow markets to digest over time, in real time, what's going on?
I think if there's enough of a gap of time, then I'm definitely comfortable with that. Figuring out what the right gap is hard, and it's very important not to create a stigma.
Let me go to Mr. Rosner.
Sure.
Yeah, I don't have that much time, so
If
I
we
appreciate
believe
this.
that these shareholder-owned corporations have an obligation to shareholders, and we believe that markets can only work efficiently where there's symmetry of information, how can we argue against the disclosure of that information on the belief that there is no such thing as a rational investor who can read a balance sheet, understand an income statement, and know what assets are on a bank's balance sheet?
Thank you. We'll go to Dr. Sanders and then Mr. Eli.
Again, I see Mr. Elliott's point. A delay might make some sense. However, the problem is that if you look at many major banks around the world, Europe, the United States, if you mark their books to market on all their asset-backed securities and MBS, they'd all be insolvent. So I think that signal's already out there. So under those set of circumstances, I don't see the necessity to keep the Fed keeping everything blind.
Okay. Let's go to Mr. Eli and then finish with Dr. Lockman. if
Just
we
very
could.
quickly, I just
Very
think
quickly.
in this day and age, it's naive to think that you can keep the markets ignorant of what's really going on. There's an enormous amount of chatter that takes place in the money markets, and you have the analysts. But the real downside of trying not to disclose information in any approaching real-time basis is rumors develop. And so people may make judgments and basically kind of see false negatives in the sense that they will assume that maybe the problem is more widespread or is spread to a particular institution when in fact it is not. So there's a downside to not disclosing information.
Thank you very much. I just have my remaining time to Dr. Lockman.
I think in the European context, the problem's a lot deeper. It's that the Europeans have allowed the banks to keep the sovereign debt of the periphery on their banking book at 100 cents on the dollar, which is patently not correct. So we get the ridiculous result that we had, that Mr. Rosner mentioned, that you have a stress test that says all of these banks are just fine because we're assuming that it's impossible for any of the countries to default. So I think that they're not doing a service by being very opaque and actually encouraging the perpetuation of some sort of myth that these debts are in fact going to be repaid.
Okay. I want to thank the panel. Great panel. Mr. Chairman, I yield back.
I thank my colleague. We'll now start a second round, and I recognize myself for 5 minutes. So I guess the question is, how large do you envision this swap line? How large do you think it could get? I mean, in the crisis in the 08-09, we hit about $600 billion in the swap line. Dr. Lockman, what's your view? If you all could just keep it brief on this round.
No, I think that you could quite easily go up to 600 billion euro. You know, you're talking about a European banking system that is huge in relation to that of the United States, that you're talking about an economy that's a third of the global economy, that the banking sector is really very important. So the chances of you going to $600 billion, I'm just thinking in terms of the amount of money that the United States money market funds have parked, it's $1 trillion. So to get above 600 billion wouldn't seem to me a stretch.
Dr. Sanders?
Oh, I agree with Dr. Lockman. I think, in fact, it could get above that amount and get to the $1 trillion level, or perhaps even higher. And again, the problem is, since we're not seeing what's going on in real time, I know Chairman Bernanke yesterday said no plans to bail out Europe. But again, since it's all off balance sheet and we can't see it, I would say that they probably are going to expand the swap lines.
Mr. Elliott?
Short answer is I don't know. I'm not deeply worried about it, though. The European Central Bank is a very, very good credit.
I don't think you can know until you have a sense as to how they're going to move forward in trying to resolve the crisis, recognize the losses, address it. Obviously, from a dollar funding need in the European banking system today, if we continue on this trajectory, I don't disagree with either Dr. Sanders or Dr. Lockman, but it's unknowable at this point.
Sure.
I agree that it's unknowable. However, the longer these problems continue and the greater the continuing uncertainty about the strength of these banks and their parent governments, then one can easily see the amount drawn under the swap lines going up and up and up. So what I worry about as much as anything else is the prolongation of it. You know, when is the fever going to break? When will things start to turn around? When will banks be able to resume or be able to fund themselves more in the private markets? That, to me, is what the real key issue is. And until we get to that point where there is greater market confidence in the banks, we're going to see substantial amounts drawn under the lines and maybe even approaching $1 trillion.
Mr. Elliott, so let's say the Fed goes beyond simply the swap line, which they had in the last crisis. You know, we're expressing concern now based on our view of the survivability of Europe and the Eurozone as it's currently constructed. What if they go beyond that? What policy options do you believe the Fed has in the event of even greater stress in the European financial markets? Throw out some scenarios that you could envision happening.
Sure. The scenarios I'm going to throw out, I think, are extremely unlikely, and I don't think we'd probably want them to do it. I mean, look, the Fed could do the same thing. Actually, I haven't checked legally, but I imagine that they could do the same thing that the various central banks in Europe are doing, which is find a way to get some money into the IMF, for example, or find a way to loan money to the European Financial Stability Fund or something like that. But I just don't see, nor do I think it would be desirable for the Fed to be putting money directly into any of these rescue funds. I think mostly the Fed's at the limit of what it can do directly as regards Europe. Obviously, it could do more monetary stimulus here to deal with concerns about Europe, but I don't think there's a lot of room to do things.
Well, and European banks that have a presence in the United States already have an open line with the Fed as it stands now. But their open markets function because they too are American banks, have a presence.
Exactly.
Could you envision the Fed purchasing American-originated assets held by European banks? Could they do that?
I believe they could. I think it's hard to imagine unless they were making the same opportunity available to other banks to sell the same kind of assets.
Okay, but American-originated, I mean, that would be sort of the nexus there.
Yeah.
Could you imagine a TALF-like facility for European assets? European bank assets?
I think if the assets are U.S. assets, yes, I could imagine doing another version of the TALF. If the assets are basically European-based assets, it's hard for me to imagine us doing that.
Okay. No, I'm just asking scenarios because the range of options, what we saw the Fed do in the last crisis, and to Dr. Sanders' point, this question about was it $7 trillion or was it $1 trillion or a trillion and a half, the real question the American citizen, the average American citizen has is what is the Federal Reserve doing? And so this lack of information means that many Americans will just simply fill in the blanks on what happens in that black box. To Mr. Rosner's point, which is a bank's actual assets and you know, as a stockholder of a bank, it's hard to tell if the bank is doing great or awfully, or what the range is in between. So that lack of information, that's the reason why I want to at least have some scenarios, so we're not completely surprised by Fed's. Mr. Rosner.
Yeah, I was just going to say, in the short term, it doesn't seem like the Fed is going to have to take a lot more action than they've done with the swap line, in part because, again, in an attempt to kick the can down the road, we've seen the European Central Bank offer 1% money for 3 years to their banks. It seems increasingly likely that the way that they're going to deal with sovereign debt auctions next year is banks within each sovereign nation are going to be increasingly called on to be the large purchasers of those issuances, which has negative implications for economic growth and for the overall economies on the other side, as much as they're helpful in the short term. But I would think that the approaches to kicking the can actually are going to, in the short term, ameliorate much further need for U.S. involvement, or Fed involvement, I should say.
Because the ECB will actually do what's necessary, or will it be the policymakers that are kicking the can down the road?
The policymakers are kicking the can, and the ECB is, at this point, trying to step back from the fold and the pressure of stepping in. I think ultimately they will end up folding and stepping in a large way.
Okay. Well, my time is expired, and I now recognize Mr. Meehan for 5 minutes.
Thank you, Mr. Chairman. Sort of, where do you jump in with all of this? Is there anything, we're talking here about monetary policy sort of in the current situation. Is there anything that's being implicated here by a failure for certain of these countries to really adopt austerity measures that may be able to address some of this, or do we need to continue the sort of IMF support and otherwise to sustain it from a meltdown? Anybody can jump in on that.
I'll start off. Again, just start off at the top. Bear in mind that Commerzbank is in deep trouble in Germany. Dexia is gone. Crédit Agricole in France. If we have any of these write-downs, it's just going to sink the European banks, which will then result in who's going to come to the rescue. I just don't think this is a solvable solution. Greece, there's riots. Italy, there's riots about austerity.
Right.
I just don't think it's solvable. Again, it's not a liquidity problem. It is definitely a problem of the fact that they're all insolvent. I mean, the Titanic sank in a highly liquid environment.
Well, then, if that's the conclusion, then are we just, if we kick this can down the road, so to speak, when's the day of reckoning? Dr. Lackman.
The trouble is that the road is getting shorter, that we can't keep kicking this can down the road. We're going to come, my view is that we're going to come to some resolution fairly quickly. It's difficult to see how you can string this along for another year, given the state of the economies, given the political resistance to adopting different measures. The point is that a number of these countries are insolvent, but the second point I'd make is you're talking about huge amounts of debt in question. So if we just look at Portugal, Greece, Ireland, we're talking about $1 trillion. If you add in Spain, you're talking about another $1 trillion. If you throw in Italy, you're talking about another $2 trillion. We're talking about $4 trillion that is going to have to be written down at some stage. So that is going to have a huge impact on the European banking system when that occurs. And given the interconnections between the European banking system and the United States banking system, it's very difficult to see how the United States avoids a financial crisis if you do get Europe playing out in a bad way.
And what would be the specific implications on the United States from that scenario?
Well, the specific impact on the United States is that the United States banks would be put under a huge amount of stress, that you'd have a credit crunch in the United States. The United States would go into a meaningful recession. That would compound the problems. I think that the way to look at it is like what occurred in the United States during the Lehman crisis.
That's what I was going to ask. We're right back where we were before.
The same way as that ricocheted around the world, now what we would be having is we'd be having a crisis where the origin was in Europe, the world's third largest economy, a larger economy than that of the United States, that would have reverberations through the globe, and the United States would be impacted.
Why don't you do Mr. Elliott and then Mr. Rosner?
Yeah, thank you. I just wanted to say, to give you a wider view, I think that the countries that much of the panel here thinks are insolvent aren't necessarily insolvent. Greece, clearly. But Italy, for example, Italy this year is going to run a primary surplus, meaning that absent the interest payments, it's actually in surplus. It has had, in the past decade, a number of years in which the primary surplus was 4 or 5% of GDP.
What's that attributable to?
Basically, in the last decade or so, they have managed their deficits much better than they had historically, and certainly far better than us. In the last decade, they had deficits, and these aren't primary, these are actual deficits as we normally look at. They've had deficits lower than Germany over that decade, lower than France. So my point about the politics earlier is, assuming that Italy is insolvent essentially assumes their political system is so bad they can't find a way to pare a few more points of GDP off of their deficit, and they've shown in the past they can, even under worse political environment.
Two things. First of all, just in response to this, you have to remember that we are talking about the problems in Europe that we're talking about with the backdrop of the past 3 years having had decent growth in the Eurozone, and that's over. Okay, they're heading into recession. Even the core is going to be suffering that. Secondly, though, I think it's important to remember the more recent European Bank Authority stress tests and the agreement that the banks raise core capital to 9% by next summer are being done in a way that's even more damaging to growth and is going to put more risk.
Because there's going to be less capital out in the European markets?
Well, because rather than forcing them to, in short order, regardless of the dilution, issue equity to raise real capital, we're giving the banks enough time that they're going to try and get there by reducing their books, by deleveraging. And that deleveraging is going to create further problems, kicking the can further and shrinking growth further, as opposed to forcing dilutive equity raises, which should be forced. That's where the capital should be coming from, the markets, regardless of price right now. I would point back to our crisis. Had we forced Freddie Mac to raise equity in January and February of 2008 and not accepted their arguments that those would have been highly dilutive capital raisings, we might not have ended up where we ended up. Instead, we allowed it to string along, and that had a zombie institution that was fundamentally increasingly taking risks with less economic returns on those risks to cover up or try and hide the problem. So we are now partaking in a game of allowing the European banks to get their house in order by reducing credit availability to the Eurozone, instead of forcing them to dilute shareholders.
That's going to have an impact as well on the overall ability for that economy to
absolutely,
to
which is why I find it so offensive that we are supporting policies that put the burden on taxpayers rather than on equity holders, preferred holders, sub-debt, unsecured creditors, rather than in manners that allow them to negatively impact the economy in another way, which is the deleveraging.
Mr. Ely, you have some thoughts?
If I could just put another angle on this, the problem in many of the European countries, particularly the weaker ones, isn't just the current level of debt and the debt-to-GDP ratio, but it is the ongoing deficits, many of which reflect structural barriers in the economy, entitlement programs, early retirement, and so forth. And so these countries are in a situation where it's not only at a high debt level, but it's a debt level that's continuing to rise. And so they not only have the challenge, these countries not only face the challenge of rolling over existing debt, but also having to borrow more and more in order to finance the continuing
That was the implication of my question about austerity.
Yeah.
I mean, is that what you're talking? I mean, that was the language I used, austerity. But are you?
Now, it gets worse than that. When the austerity starts kicking in and unemployment starts rising, you have a shrinking GDP, you're going to have shrinking government receipts, increased spending, and so the financing need in an absolute sense goes up. And what we're starting to see in some of these countries now are increasing interest rates on government debt as they try to roll it over. And the question then becomes one of, when do some of these countries hit the wall and they simply can't roll all their debt? We got a little bit of a wake-up call on that a couple of weeks ago when Germany could not sell all of some 10-year debt that it came to market with. And where I think the real crunch comes is when a country has debt coming due, and it simply can't roll it over at any interest rate. The markets won't buy it. This is essentially the same as a bank not being able to roll over its funding. And then that's when the real crunch hits, and you get an honest-to-God government debt default. Now, whether it's
we get a default, we get hyperinflation. What will be the result?
Well, I don't think we can have hyperinflation because governments don't pay their bills in currency anymore. But I think what happens is that governments, I would think, would be in a situation where they just would have to cut back on the payments they make, whether it's they cut back on Social Security or pension payments or whatever. And again, going to a point that I think Josh referenced earlier, that's when you start to see the riots. And so I think that that's a very, very serious concern when these countries simply can't not just roll over their debt, but also finance the ongoing deficits.
Mr. Chairman, I yield back. Thank you.
Well, this was an amazing exchange and fascinating discussion. Mr. Reisner, you mentioned in your testimony, you've mentioned a number of times you believe many of these European banks are insolvent. So, to that point, the ECB actually levied a penalty in order to force European banks to pay off the swap line, the Fed swap line. Would that be an indication of insolvency, that they're using short-term paper for long-term debt? Or
It could be, but it could be just, on the other side, that could be just liquidity, right? Depends on the funding of assets. It depends on the assets. So it's unclear, which is, again, part of the reason it would be nice to understand who was drawing so we could then actually trace it back, take a better look at the assets that they have, if we got those disclosures to see what they're funding.
But at a time when the Fed—
And by the way, it would be nice to be assured that the Fed knows who's drawing on the swap lines and what the assets are that the ultimate borrower from the ECB
Actually, to that point,
has.
Mr. Elliott, do you agree that the disclosure of those swap lines would be helpful?
Yeah, I'm of mixed minds about it, because the thing is, our swap is with the European Central Bank. That's our credit risk. It's up to them what they do with that. Now, the reason I might agree that it would be useful is, to the extent that we're deliberately helping them with their policy, I could see a desire to know what they're doing. But I don't know that we need the level of detail that's being asked for in terms of that.
Even with our U.S. banks that have risk, with counterparty risk associated with that?
Oh, and look, I mean, that we would want to know in general. Obviously, we'd want to know, we'd want our banks to have reasonable information about the situation of their counterparties. But there are multiple ways to get that information. It doesn't necessarily have to be knowing whether and when they've been using the swap line. I might also add, the dollar is the world's currency.
And we're hopeful to retain that.
Yeah, I would love to retain that, too. The fact that there are European banks who have trouble getting enough dollars in this environment is, as Josh was saying, it might be a problem of solvency, but it might very easily not be. I would worry that, again, about the stigma issue, that in this environment, that investment managers who want to keep their jobs by just not taking chances would look at the information and say, oh, good, those guys use the swap line, I better just stay away from them. Because staying away from them won't hurt me that much, and being there, if it turns out they go under, means I lose my job.
Well, I mean, we're only disclosing I think the Fed discloses 2 years after the fact.
Oh,
on this. So
I don't have
a year? Is it 6 months? But, you know, it's certainly.
Sure. I don't have a problem with something like 2 years. I thought you were talking about, in this case with the ECB, something that would be
Well, we don't
more
even know, with the disclosure of $600 billion with this swap line, when at the height of the crisis, we don't even know where that went. That is really the crux of this discussion. That's the reason why that came up. Mr. Rosner?
Yeah, I just wanted to say, whether the Fed discloses the information or not, I can't imagine why the Fed wouldn't and shouldn't demand of the ECB to know who is ultimately drawing upon those lines, so the Fed can see whether their swap lines, which were intended to provide liquidity in dollar funding markets, were being used to prop up insolvent institutions. Whether that's disclosed broadly or not to the public is an area that I think deserves debate. I know where I fall on it, but I can understand the arguments on both sides. That the Fed should not want that information for their own analysis, for their own prudential purposes, doesn't make sense to me.
So here's a broad question. What is American financial system's exposure to Europe? And because the question is, if we have an extraordinary exposure, then we have an extraordinary, there would be an extraordinary policy desire to bail them out in order to save our institutions.
Yeah, the BIS figures, Bank for International Settlement, says that our banking system, not insurers and pension funds, but to the banking system, has about $2 trillion of exposure, credit exposure of various kinds to the Eurozone, or 2.7, I think, and 2 to the UK, or I may have the 2 reversed. I usually roll the UK into this because it's so closely tied in with the Eurozone.
Even though they're trying to extricate themselves.
Exactly. If you combine those, that's about $5 trillion. But again, that doesn't count some other parts of our financial system.
Could I add to that?
Sure.
Talk also in terms of what I'll call direct exposure, as Doug was talking about, and then what I'm going to call is an indirect or macro exposure, and that is that if Europe really blows up, and I certainly hope it doesn't, but if it really does blow up and they get an enormous economic contraction in Europe, that's going to have dramatic global effects on the macroeconomy, certainly on the United States. And then you ask, what kind of new problems does that create for the U.S. financial system and the banks, for instance, with regard to house prices? And, will we have rising unemployment? So we have to be cognizant not only of what I'll call the direct balance sheet risk, but then the indirect but potentially very expensive macroeconomic indirect risks.
Some of which we're already seeing as the dollar continues to strengthen, right? The dollar strengthening is going to have a negative impact on the export markets. It'll, on the other side, have positive impact on some of our domestic asset prices as capital flows back into the country. So, it's very hard to quantify. I would just point out that when we keep throwing out this multi-trillion-dollar number, that we also have to remember that that's a total exposure you need to net out of that private capital and private capital structures, which I think at some point were there with a priority of capital for an understanding that that was risk capital. That capital may end up being wiped out and needs to be backed out of those assumptions, because I'm not sure it's necessarily prudent for us to consider that obligations that the government really needs to consider as opposed to private creditors and shareholders to consider.
Dr. Lockman, do you want to follow up on that?
Back to a point that Mr. Rosner raised, which I think is crucial, the idea that the European banks do have an enormous hole in their balance sheets. The IMF has estimated that number is at least something like $300 billion. And what that is producing, because of the way in which they're letting the banks get to the capital ratio of 9% by June, is they're going to have a capital reduction. They're going to be reducing credit to the tune of something like $2 trillion over the next year. When you have that kind of credit contraction at the same time that you're asking the countries to engage in massive fiscal tightening, it's the equivalent of tightening monetary policy, tightening fiscal policy in the middle of economic weakening. That is a recipe for a deep recession, and that's the reason that I don't think that this can work.
Dr. Sanders.
To build on what Dr. Lockman said, the ECB announced, I believe it was yesterday, that they're going to modify capital requirements for the banks in Europe. Why? Because they see credit contraction being very serious, as we just saw here. And so what that probably means is they're going to require less capital, which again just makes the financial institutions more risky, which will eventually put American taxpayers at more risk. This is kind of a never-ending game.
Well, they're thinly capitalized going in because Basel said that if you're holding sovereigns, there's no risk associated with it. So it's kind of a fascinating situation. So, there's, so many questions about this. Dr. Lockman, you mentioned the exposure through money markets. We had one money market, one fund that broke the buck. That's it. Most investors don't quite understand what a money market fund is. It's not FDIC insured, and part of what happened in the crisis is actually making that worse in people's minds, that there'll be some government savior of the money market fund. What is that exposure to the European financial system, our money market funds to their European financial system?
The estimates made around about June by the Fitch rating agency suggested that United States money market funds had around about 45% of their funds on deposit with European banks. The money market industry is something like an industry of $2.7 trillion. So if you take 45% of 2.7, you're well over $1 trillion. What's occurred in recent months is that they've brought down that exposure to 35%, but that is still a very large exposure.
It was, as recently as, if I recall, 12 or 18 months ago, over 60%. But a lot of that was peripheral economies in Europe. There's almost no exposures to peripheral economies in Europe at this point by U.S. money market funds. It is almost all the core, with some smattering until recently of Spain and Italy.
Yeah, but if that I don't take much comfort in that argument, because if the banks in the core are exposed to the periphery, then so are the money market funds exposed to the periphery if they've got deposits on with the core.
I agree completely with that point and would suggest that I made it just to point out that this is not a peripheral problem as it's constantly being spun. It is a problem of the core banks as much as it's a problem of anything else.
So, okay, there's this, Mr. Elliott, you mentioned in your opening, 3 out of 4 chance, basically that the euro will survive, to paraphrase you. Give me your view on Greece remaining in the euro. Give me your percentage chance that they are still in the euro a year, whatever the time frame is you want to choose.
Sure. And just to clear up any potential confusion, my 3 and 4 probability that I put out, which is obviously it's a quantification of an intuition, because this is very, very hard to know. But what I meant was more than just the euro surviving, but that there'd be no defaults beyond Greece. So I meant it stronger than you may have seen that.
Oh, okay.
And then in terms of Greece staying in the euro, I actually think it's pretty likely that Greece will stay in the euro, in that there are a lot of advantages, even with defaulting, which they clearly are going to do, whatever it's called. There are a lot of advantages to staying within the euro. Now, I know Dr. Lockman very much disagrees with that, but there are pros and cons. Most of the people I talk to feel that Greece will actually try very hard to stay in the euro.
Okay, but, since Greece has become a modern country, the last 150, 170 years, they don't really have a great track record on paying people back.
No, I mean,
that's just history. I mean,
they're defaulting. There's no question they're defaulting. I'm saying that's a different thing from pulling out of the euro.
So it's a matter of what they call it and when it happens, is what you're saying.
Yes. I don't think there's anybody on this planet at this point that thinks the Greeks are going to pay back 100 euro cents on the euro on their debt. We know that's not going to happen. And then, as has been pointed out, there's been this rather dangerous thing of trying to arrange it so it doesn't technically act as a default, which I think has done terrible damage to the credit default swap market.
And everybody agrees on that on the panel. Does anybody disagree that the harm in the credit default swap market is serious when we have this type of action? Okay. Now, so about Greece, okay? So it's a question of everybody agrees they're going to default. Is that true? Okay. Now, it's a question of what they call it when it happens. Is that really the question?
And how much?
Okay.
And if I could add to that, to what extent are the issuers of CDS going to have to take a loss? And then you get into this is where another set of dominoes could start toppling in terms of where is the CDS risk on the German debt, and how are those losses going to hit, and who are they going to hit? And I assume it's not just banks, but insurers and insurance companies and other types of institutional risk takers. And that's unknown from what I can tell.
Dr. Lockman.
Yeah, I think when you're discussing Greek defaulting on its debt and having a disorderly default that might involve writing down the debt by 70, 80 cents on the dollar, what you also have to take into account is the contagion effect that is going to have through the rest of the periphery. The European Central Bank, for the past year and a half, has been trying to fight the idea of default because they know that if Greece defaults, what you're going to have is the Greek banking system wiped out, you're going to have capital controls, you're going to have runs on banks, and all the rest. That'll set an example for depositors in Portugal, in Ireland, and so on. So it's very likely that if you do get a disorderly Greek default, you're going to get real pressure on the rest of the periphery that is going to cause a chain of defaults, and that is the reason that the European Central Bank has been putting up this fight, which I'm pretty sure that they won't win. In the case of Greece, it's really a matter of time. We're talking about months, if not weeks, before this event is going to occur.
Now, I've heard the one theory that they just need a current account balance, then it is absolutely in their national interest to simply walk away from their debt. I mean, as long as they can cash flow their government, in essence. Is that similar to your point of view?
Well, but it's a question that Greece is not in a position to pay the debt, that what is occurring is that over the last 2 years, Greece's GDP has contracted by 12%. The unemployment rate is at 18.5%. Their economy is literally now in free fall. That is eroding their tax base. They can't meet the budget targets, so they've got to do more austerity, and the people are out in the streets. Greece is not in a position to take more fiscal measures, and that is, at that stage, it's very difficult for the IMF to keep throwing more and more money at a country that is palpably insolvent. That is the point at which Greece defaults, and we're not far away from it. There's a new government. There are going to be elections in Greece around about February, middle of February, end of February. I would expect that it's around about that time that you'll see Greece leaving.
So with my accent, that would sound like doom and gloom, but you make it sound more upbeat. I'm only joking. Mr. Elliott, you believe the IMF doesn't need further capitalization. There's this authorization within Dodd-Frank that's been discussed that Treasury could authorize another $100 billion for the IMF, and they have that legal right. The administration would just simply have to make that decision. But your view is that the IMF is fully capitalized enough to take on what you would view as sort of the crest of this crisis in your scenarios?
That is my view, in the sense I believe this has to be basically solved in Europe. I think it's very useful to have the IMF bring in enough funds to be a serious player, but I don't think that takes it beyond its present resources.
What is that dollar amount?
I'm sorry,
what is that dollar amount?
Well, they've got $390 billion now that's available, and they'll have more if the if the various central banks within Europe do contribute to the IMF.
Does anyone on the panel disagree? Dr. Lachman.
Right. I think that if you look at the amount of money that the IMF would have to provide to Italy and Spain if they did the same thing as they did to Greece, Portugal, and Ireland, you'd be talking about $750 billion for Italy alone. You'd be talking about another $400 billion for Spain. The IMF simply does not have that kind of money. I totally agree with Mr. Elliott that the onus of sorting this out should be Europe. It should not be the United States taxpayer. What the Europeans are trying to do is they're trying to loan money to the IMF, get a claim on the IMF, and have the IMF loan money to Italy, which would put the United States taxpayer on the hook for 17.75% of whatever the size of the loan is. I think that that should not be permitted.
Now, the opportunity for China to inject themselves in the IMF and put forward, the equivalent amount in order to take on that sort of crest, and another $200 billion, let's say, is that sort of in your range of options or likely?
Right. Well, that could very well occur, but you've got the same problem as you do with the Europeans lending to the IMF. If the loans are made in a form that China has a claim on the IMF, and the IMF then goes and uses that money to lend to Italy, the United States taxpayer is exposed to that loan to Italy as a shareholder having 17.75% in the IMF. The way that those loans should be made is they should be made through an administered account where the IMF is just a conduit, and it doesn't expose the shareholders to any risk of those loans.
Mr. Ely?
One of the things that I think we have to do is step back a little bit and realize that whether it's through the IMF or other lending facilities, you essentially have governments, either directly or through the IMF, becoming funders of these really deeply indebted countries. In other words, the private market pulls back, governments step into the void and fill it. But as I mentioned in an earlier reply, you still have these ongoing deficits in these countries. So all this does is kind of keep the ship afloat for a little bit longer. We're kind of bailing faster, but the ship still has big holes in it and is sinking. And so the question is, do you have enough time for these liquidity provisions to enable these governments to make the structural reforms they need and get back on track? And I don't think the liquidity can keep things afloat long enough for these countries to make those changes. Plus, we're seeing backsliding in Greece, for instance. It's been mentioned earlier. So, you know, the question is, are we really solving anything, or are we just digging a deeper and deeper hole with now the taxpayers, not just the United States but elsewhere, increasingly at risk as we try to protect creditors by the governments being, if you will, taking out, if you will, paying off private sector creditors that have lent to these countries.
All right, thank you. And I now yield to Mr. Meehan, and we'll finish after that, just so the panel is aware of our time frame. After his line of questioning, we'll finish.
Well, I thank you again for your very interesting testimony. Mr. Ely, that's what I was trying to, what you were just discussing. Wasn't Dr. Lackman, didn't you in your testimony more or less suggest that the combination of austerity and the growing challenges in Greece make them incapable of taking on same demands? As we talked about austerity, if you move them into Ireland and Italy and other kinds of places, this just becomes a cascading effect. Is that what we're seeing?
I'll let Desmond speak for himself, but I think that's a very serious risk in the most indebted of the countries who are experiencing the greatest degrees of austerity, with all the negative consequences of that, of rising unemployment and declining tax receipts and increased government spending. It just means that the deficit, the current deficit in these countries just continues on, and that means that they have to borrow more, their debt-to-GDP ratio goes up. The question is, how high can it go before they simply can't roll over existing debt and fund next month's deficit?
I'd say that the problem, certainly extends beyond Greece, that countries like Portugal and Ireland are in not that much better shape than Greece. Italy and Spain, their positions are stronger than that of Greece, but they conceptually have to do the same sort of thing that Greece had to do, which is tighten the budget by a large amount. We're talking about 2% of GDP in Italy in 2012, again in 2013, again in 2014. And as Josh Rosner was pointing out, they're having to do it in the context where there's a credit crunch and where there's a deterioration in the external environment. So it remains to be seen whether countries like Spain and Italy can withstand many years of fiscal austerity, declining growth, rising unemployment, calls for more austerity. The social fabric generally doesn't hold up well to this. It's just of note that already, relatively early in the crisis, we've seen 5 governments fall in the 5 affected countries. So I'm not sure that they can stick to this road of austerity and very poor economic outlook for a very long time, when it would be perceived that the reason that they're doing it is to keep the banks in France and Germany afloat.
If I make one quick point, each of the governments that fell was replaced by a government that was more favorable to the austerity measures.
We've talked a lot about, I just really have 2 other questions. We've talked a lot about this in the context, as I've been following this, Europe having to deal with its internal crisis and its relationship back to the United States because of our involvement with supporting the IMF and therefore assuming some of this responsibility. I also take from this that we are worried about the recessionary implications on our own economy if we have problems in Europe. How about other thriving other economies, the Asian economy, South America? Are we watching them being isolated in any way, or are they similarly going to be impacted by this, and effectively we're seeing the front end of a global recession? And please, jump in.
Yeah, so I think it's an important point to raise, because I think that is another piece of it. Large portions of the Chinese economy are funded through European banks. Europe is obviously China's largest export market. Much of the South and Central American economies are funded also through European banks. So it definitionally is a global crisis. How deep it impacts various parts of the globe are obviously going to be different and dependent on the outcomes here. But it certainly is worth considering it as far more than just a European crisis, especially since many of those economies to which we export, to the degree that we do, get their funding from Europe.
If I could just add to that, I think it's not just a funding issue, but particularly for China, it's ultimately a social unrest potential, because, again, they export so much to Europe and, of course, to the U.S., and if we have a slowdown in both the U.S. and Europe, that's going to have a negative impact on China and on its level of employment. And I've always been concerned about China being somewhat of a tinderbox. It's amazing how often we read of local disturbances in China. So there's a fabric there that is not as socially strong as it is in this country. So I think we do have to be worried about those secondary and tertiary effects, and particularly in China, since it is such an export-driven economy.
My last questions relate to points that I wasn't really able to fully understand. And as I was listening to American Exposure, it largely was discussed in the context of our participation in the IMF. How about some of other institutions, and how does that relate back to the typical American investor, the guy who buys into a money market fund, whose retirement is dependent on some extent on these kinds of things? So my questions relate to how is the everyday American who has some portfolio of investments going to be impacted by these things, and do we have impacts on our pension funds or any other kinds of insurers like we had with AIG that aren't really being considered as or being discussed as much, but may have genuine exposure? So this is the last question that I have, and so people can
take a stab at that. Ultimately, individuals are the owners of the economy. There are various levels of financial institutions, and you've rattled off insurance companies, pension funds, and so forth. To the extent that there are capital losses borne by American financial institutions, that's going to reverberate back to individuals, either in terms of losses in their own portfolio, a hit on, let's say, corporate pension funds, union pension funds. It could be across a broad range of financial intermediaries, but ultimately that loss is going to come back to individuals and families in this country. It's unavoidable. There's no someone standing behind the curtain that's going to absorb those losses. They come back onto us, everybody in this room.
Yeah, and if I could emphasize a point Bert made earlier that I'm sure we all agree on, the indirect effects will be larger. If you think about what it would be like to go through another recession after we're still in this very slow recovery, that's going to be an even bigger effect than the direct market impacts.
And I want to add one other thing. I do agree with Mr. Elliott, but if you look at my figure 11 in my presentation, the Fed is literally out of bullets. We're not going to have really a great ability for the Fed to step in and provide any sort of intervention, or the government issuing more treasuries. It just isn't affecting GDP anymore. We're kind of numb to further government intervention. So now we're in a rock and a hard place.
Well, on that bright note, Mr. Chairman, I yield back.
I thank my colleague, Mr. Meehan. Thank you so much. Now, I said that was the end of the questions. I have one more, if you don't mind, and we'll just start with Mr. Ely and go across. Tomorrow we have President Dudley of the New York Fed. We have the individual at the Federal Reserve Board downtown here who deals with international markets. We'll also have a representative from Treasury. I know it's a long commute from them. They're even closer than the Fed, and certainly closer than New York. But what questions would you ask tomorrow? What question, if you had to boil it down, would you ask in tomorrow's hearing?
The question I would ask is, ladies and gentlemen, how is this going to play out over the next 6 months to a year? Now, I don't expect you to get a very candid answer, but I think that that's the question. What are various scenarios as to how this situation can play out over the next 6 months to a year, and what are going to be the feedback effects? What will be the feedback effects on the U.S. economy?
Mr. Rosner.
I provided specific questions in my testimony.
Yes.
Which I'm going to refer to.
What's your number one? Give me,
Well, what comfort do they have that 17 countries, each with different political dynamics at home, are going to be able to come to a solution? And what is the purpose of their policy tied to that? Short-term, medium-term, long-term, what is the Fed's policy purpose here in an environment where, while most of those 17 leaders actually do have some agreement as what they'd like to see have happen, they have very different social dynamics in their home countries with their populations, constituents, making it difficult to achieve that. So what is the purpose of Fed policy and Treasury policy in the short term, in the medium term, in the long term as it relates to the single currency?
okay. Mr. Elliott.
I think if I had one question, I would ask them to talk about this solvency versus liquidity question. Do they believe that the weaker countries in Europe, ex-Greece, are suffering from a liquidity problem, or is it a solvency problem? And I assume they're going to say liquidity, and then the follow-up question would be, how do you come to that conclusion?
Dr. Sanders.
I would ask the Fed, if you had one bullet left, would you use it for the American economy? Not to shoot ourselves, I meant to help us out. Or would you use it for Europe? And then for the Treasury, which I would be most interested in hearing, I want to hear their assessment of, when I agree with Dr. Lockman, I did have the same calculation, $4 trillion is really the tab to really bail out those, Italy and those the peripherals. And if we're talking about $100 billion of an additional $200 billion, is that like throwing the money away, or is this going to end up being a much, much, much bigger amount? And I don't want to say that will never happen. Come on, we've already seen a lot of bad things happen.
Dr. Lockman.
I would just suggest a couple of questions. One of them would be the variant of Mr. Elliott's solvency versus liquidity problem. I would phrase it differently. I would phrase it, why do you expect imposing fiscal austerity on countries at a time of economic weakening and a time of a major credit crunch in Europe is not going to lead to a big recession that is going to unravel the public finances of the countries involved? A second question I would ask is, why do they think that a policy approach to Italy and Spain that they've tried and has failed in Greece, Portugal, and Ireland is going to work this time around? And I guess the most important question I would want to ask would be, how are they going to be safeguarding United States taxpayers' money from these loans that the Europeans are making to the IMF, which is putting the U.S. taxpayer on the hook if that money is then used to lend to Italy and Spain?
Okay. Quite a number of questions. What is clear about this hearing, and I thank you so much for being here. This is very helpful, very useful information, and a very wide-ranging discussion. I appreciate the panel's willingness to engage in that conversation. What is clear is there are an enormous number of questions that experts have about Fed policy and about this administration's policy, about an exposure, and the American taxpayer exposure to the European financial crisis that they're facing. At its heart, to Dr. Sanders, in your opening, this was about excessive government spending and excessive debt, as well as what Mr. Rosner said. This was about overlending and overborrowing. And one is more focused on the government, the other is more focused on the banking and the institutions. But the economic risk is real to the American taxpayer. It's a question of the magnitude of that risk. Our exposure to Europe is real, both to the American taxpayer and these institutions such as the IMF, as well as to the American worker and their ability to get a job and to have a growing economy. But there is some consensus here about the likelihood of a Greek default. The question is, what does that look like? When does that happen? And what is that raw cost in terms of currency? But obviously a mixed assessment on the survival and the ability of the euro to survive in the medium and long term. There is not consensus there. But this has been very helpful and very instructive. I appreciate your time, and members will have 7 legislative days to submit opening statements. And with that, this meeting is now adjourned.